Good afternoon, everyone, and thank you for joining us. My name's Heather Britton, and I'm one of the tax directors in the Property Tax Advisory team at Francis Clark. So, welcome to the first of our PKF Francis Clark 2024 property webinars. The focus of the webinar today will be on construction and development issues, and tomorrow our webinar will focus on property owners. So, with the news last week that the UK economy is now officially out of recession and grew by 0.6%, some may see this as cautious good news. However, amongst the headlines, it was commented that the construction industry is amongst those sectors that actually did shrink. So, there are still continuing to be challenges in the industry. I'd like to welcome our speakers today, and they will be talking to you about a number of issues. So first of all, we have Michael Hall, who's a director in our business recovery team. And Michael will be talking to you about the importance of protecting the construction industry against insolvencies. We'll then be hearing from Michelle, who's a manager in our VAT team who specialises in property tax. And she'll be talking about VAT issues, including the domestic reverse charge and the implications of those with future and past property transactions, particularly in relation to options to tax, which many clients find a tricky area. And finally, we'll be joined by our duo of Paul Bray and Steve Ashworth. They are partners in the business advisory team and a director in our employment team, and they will be talking to you with some topical CIS discussions on what they're seeing and what their clients are asking. So if I may first start with some housekeeping, please do feel free to ask questions of our speakers. And in order to do that, please can you use the Q&A on the right-hand side of your screens. And please include a question you may have for one of our speakers. And we'll try and cover off as many of these as we can at the end. We'll be aiming to wrap up the webinar by 1 o'clock, so you're all away for lunch. Also, within the handout section, you'll notice there is a handout which gives contact details for all of the speakers today, so you can have their contact details, but also links to related insights and blogs on our website on topical issues, many of which are related to things we'll be covering today. So first of all, I'd like to hand you over to Michael Hall, who'll be talking to you about protecting the construction industry.
Thank you very much, Heather. Thank you for the introduction. Good afternoon, everyone. Pleasure to be here. My name is Michael Hall. I am a director in the business restructuring department. I am also a former accountant in practice. I'm also a former financier, having worked for Bank of Scotland and a private finance house. So I have over 25 years experience working in those arenas, and I'm here to talk to you briefly today about protecting your business or protecting the construction industry against insolvency. So in my day-to-day job now and for the last 16 years, I have worked in restructuring. I hold an insolvency license to take appointments as liquidator and administrator and supervisors, etc. And in my experience, I have come across issues with construction companies, or I've worked on construction company cases a number of times. It's a particularly interesting but also challenging sector. So I'm going to talk quickly about the insolvency statistics. I'm going to talk also about some of the challenges that the construction industry face as I see it, and then really moving on to how some of those risks can be minimized within the industry, and finally talk about how we can assist. So I'm just gonna, I've got the schedule here. So there we go. There's my I should have moved the slide before, I guess, but there's my my agenda. So I guess it will come, Heather's alluded to it a little bit, but insolvency statistics are published monthly, typically by the Insolvency Service, and construction always features very much at the top of the list. So these are the statistics for the period up to February, and you can see, if you squint, probably that construction is showing as the largest sector for formal insolvency. So that's liquidations, administrations, and CVAs. And I guess it won't come as a surprise to many on the webinar today, but I think over the last 12 months, I think construction has either been number one or number two in terms of numbers. Obviously, it's a very fast moving and can be complicated sector to maximize profit on. So how what are those challenges really that we see? Obviously, latterly in the last 18 months or so, we've seen a significant rise in interest rates, which has meant that finance costs have increased, further putting pressure on working capital. Since COVID, perhaps even pre-COVID, we've seen a lot of supply chain issues whereby companies are struggling to get hold of supplies due to shortages, due to transport issues, and also that's driven the cost of these supplies up. So it means that either getting hold of materials is an issue, which means that contracts end up becoming late, and there's sometimes there's penalties for that, but also when they can be secured, then often they are more expensive, which then can cause an issue with regards to contract prices and so forth. There's been skill shortages, I guess, since Brexit, and even since the vote to leave the EU. There has been probably a drop in skilled workforce that has taken place and put more pressures on businesses that operate within the construction industry, and there's no real necessarily end in sight to that. The interest rate rise has ultimately caused a drop in demand within the housing market due to affordability. Banks are now more cautious in respect to lending, and you could argue they have lent quite significantly over the years, which has fueled the house price bubble. But that does seem to have leveled off now, where the cost of living has increased, which means that potentially for new builds and even additions to existing houses, the affordability isn't there, which has resulted in a drop in demand. Overtrading is a term that we use, and I've seen that quite a lot in my experience with construction businesses, whereby a company that can be quite profitable to a certain, maybe perhaps as an SME, then gets offered contracts or gets offered additional work by a head contractor that requires them to then go and upskill to recruit further staff. Obviously, it means if the projects are bigger, then there's more potential cost overruns, there's more credit required in order to source materials, and then often the head contractor can then apply pressure in respect of valuations, and also in terms of variation sometimes, which means that the subcontractor can be put under significant cash flow pressure. So it's always something to watch out for. Obviously, people tend to like the kudos of working on larger projects, but it can cause significant problems if there is some sort of settlement done above you by a head contractor with a customer that they then look to push down the supply chain. And I put erosion of profit margin there. I guess it's clearly it's an obvious point. As I said, it sort of dovetails into the larger sort of work assignments where turnover is increasing, but it is about profit margin. And I suppose from my experience working on construction cases for different sizes, quite often it came down, or some of the issues came down to pricing. It came down to profit, and profit being eroded. So when jobs get larger, sometimes there's more sort of contractor labour used sometimes, and that can cause issues in terms of organisation, in terms of quality, when then they then have to be rectified further down the line. That then erodes the profit margin, and then you find a business actually running really for cash flow purposes, so the profit margin is sort of lost, or the tracking of that margin is lost due to due to basically either variations or due to fixing other issues, and then you're just operating on a cash flow basis where you're just trying to get money in, but not necessarily understanding what the job is actually making for the business, and in many cases it can be a loss-making contract. So it's very good practice to basically keep to monitor your position. Paperwork is key. I think if I was to give the sort of key advice, really, it's to make sure that the initial sort of contract scopes are well nailed down. You've got a sort of standard contract like a JCT contract, and that basically paperwork is filed and variations are authorised correctly, and really that it's trying to minimise the wriggle room for the customer or the head contractor to dispute your work and also dispute payment. Obviously, in terms of sort of payment, it's always a good idea to basically use your credit controls on. I'll just move on the slides here. Make sure that sort of regular valuations are taking place. Make sure that you invoice for work as it takes place, so that it can bring forward any sort of disputes. Credit control is a highly important department within any business, obviously, to maximise working capital and cash flow, and really just making sure that when there are issues with slow payers, that those are identified early, and you've got people within the team who are focusing specifically on those customers who are potentially at risk, let's say. I've put there about use of adjudication process where available. We've come across a lot of situations where it would have been useful if the companies at the time where there were disputes, whether it be to do with workmanship, whether it be to do with LADs, valuations, etc., whether they'd gone down the adjudication process. It can really help to crystallise the issues and ultimately provide a sort of hopefully a resolution that can benefit both parties. I put regular review and update of trading terms, and I think that relates to really where you're supplying goods and services to customers. And typically you might open an account with a customer, and it might be some years earlier, and sometimes you need to make sure that it is the right customer that you're engaged with contractually. Sometimes people have different companies for different projects. Sometimes they start off as a sole trader and then they incorporate, and make sure that they're up to date. Make sure also that you get a solicitor, your company solicitor, to sort of review your trading terms, particularly things like retention of title clauses. So there's an all monies clause or a specific retention of title clause that if one of your customers does suffer some sort of insolvent event, it gives you the potential to ratchet a return of those goods, particularly that might be in situ in the customer's premises at that time. Other risks, in terms of sort of insolvency, is obviously bad debt relief, VAT bad debt relief, and generally, I say overall, is identifying either the warning signs for your business. So that could be cash flow. If your business is struggling, if you suffer a bad debt that potentially can put your sort of going concern trading at risk, is recognizing those signs. The cash flow issues, the longer sort of creditor days. Obviously working capital problems, is just keeping an eye open and where possible trying to minimize those risks. So finally, I am running on, I pressed it twice, how we can help. So as I say, I work in the restructuring department. We have a team of 14 or 15 people, including myself as an insolvency practitioner, and we have three other insolvency practitioners. We advise customers, we advise Francis Clark clients, but also third-party clients as well, where they might have issues if they are in distress themselves, or they suffer a bad debt. But also, we talk about whether they have customers who are potentially at risk as well. And we actively try and approach it from a rescue perspective. So we look at all of the options available, ideally to try and avoid a formal insolvency appointment. Where we also help clients is where they have customers who are potentially at risk. We have various different credit agency data, so we can assist them by monitoring those clients to establish whether there are some red flags or warning signs with respect to their own customers' solvencies. That could be CCJs, that could be potential winding up petitions, to basically assist them to identify those risks before they crystallise. Unfortunately, if clients do go into insolvent situations, we also support, let's say, FC clients, but also other parties with respect to guiding through that process, reviewing paperwork provided by a nominated insolvency practitioner, identifying any areas of concern or risks, any areas of sort of investigation points. We have acted as a liquidator in a number of construction insolvencies at the request of creditors to sometimes provide a independent alternative liquidator of choice. So there we go. And I guess my final point is if you have some doubt with regards to your company and your trading position or some of your customers, please do reach out for early advice, because the earlier that takes place, the more options generally are open to you. I'd like to introduce you to Michelle now, who will be talking about VAT.
Yes, so I was just going to run through a few issues that we've noticed recently in certain areas. The first being the domestic reverse charge. The domestic reverse charge was introduced back in March 2021. The reverse charge is used by HMRC to prevent VAT fraud. The reverse charge puts the onus on the customer to account for the VAT instead of the supplier. Most cases of VAT fraud are where the supplier has disappeared without paying the VAT over to HMRC. The DRC applies when both the supplier and the customer are VAT registered. The supplier is to subcontractors or main contractors within the supply chain. The suppliers of a standard rated 20% or reduced rated 5% service, and the suppliers within the scope of CIS. The DRC will not apply when the services are zero rated, when the customer is not VAT registered, the services are not within CIS, or when the customer is the end user or an intermediary of an end use. For DRC, an end user is a person who will not be making onward supplies of the construction services, but using those services for their own property or as a property developer. An intermediary is someone who is connected or linked to the end user, and therefore they are treated as though they are end user. For example, if they're in the same corporate group or share an interest in the land that's being worked on. When the DRC was first introduced, HMRC gave businesses what they refer to as a soft landing, a period of time in which they allowed businesses to adjust to the new rules, but they would not penalise if it hadn't been applied correctly. This soft landing has finished now, and we are starting to see HMRC take a firmer approach where it has been applied incorrectly, in particular where VAT has been charged and it shouldn't have. Running through a couple of examples of when the DRC would apply. For example 1, ABC Electrical Limited is VAT and CIS registered, and they're providing services of electrical installation on a commercial property to a main contractor. The main contractor the main contractor is VAT registered and CIS registered, but they have not provided an end user notification, and they are going to recharge those supplies to a property owner. The property owner has provided an end user notification. So in this example, the supply by ABC Electrical to the main contractor would fall within DRC. Main contractor would self-account for the VAT in box 1 and box 4 of their VAT return, and it would have a net effect. The main contractor would then recharge those supplies to property owner. The property owner has provided end user notification. DRC will not apply, and VAT would be charged as normal by the main contractor. Taking this same example, but changing it slightly, we've got ABC Electrical, who is VAT and CIS registered, providing services of electrical installation to main contractor. The main contractor is VAT and CIS registered, but they have not provided an end user notification. Main contractor recharges those supplies to the property owner. The property owner has not provided an end user notification. The main contractor adds VAT at the standard rate to its invoice to the property owner. The property owner recovers the VAT charged as input tax. This is the instance in where we're starting to see issues. Although the main contractor may be aware that the property owner is in fact the end user, because they haven't provided end user notification, they shouldn't be charging VAT on their invoice to property owner. Property owner shouldn't be recovering that VAT because it's been incorrectly charged. So just to run through again, this is the flowchart that we follow when looking at whether the DRC should be applied or whether VAT should be charged. So are the suppliers within the scope of CIS? If they're not, normal VAT rules apply. If they are, you move on to the next question. Is the supplier standard rated or reduced rated? If it's not, normal VAT rules apply. If it is, you move on. Is your customer CIS registered? VAT registered. If they're not, normal VAT rules apply and you charge VAT. If they are, you move on to the next question. Will your payment be reported under CIS? If no, normal VAT rules. If yes, move on to the final question. Has your customer provided confirmation that it is end user? If they haven't, then the supplier would fall within the DRC. If they have, then normal VAT rules apply. We're finding that this is particularly relevant at the moment with the interest rates that are being charged by HMRC, where HMRC are able to raise assessments of VAT being incorrectly recovered where an end user notification hasn't been provided. So it's starting to become quite costly for businesses when they're getting it wrong. We always recommend that businesses do go back and review their records to ensure that they have either been given or have given end user notification where it applies. The other area that we've noticed a significant increase in issues is relating to the option to tax, in particular where a belated notification is required. The option to tax is a two-stage process. You have to make the decision to opt to tax, and then you have to notify the option to tax. The starting point for all commercial land and property transactions are exempt from VAT, unless the decision has been made by the person with an interest in the property to opt to tax to make the supplies taxable. This is called the option to tax as the business has elected to waive the right to exemption. The decision to opt is normally made to recover VAT on costs on acquisition, building costs, maintenance, or to fulfil a requirement for a TOGC transaction. Suppliers that are exempt for VAT purposes do not allow recovery of VAT to be recovered as input tax. As mentioned just a moment ago, the option to tax is a two-stage process, making the decision to opt to tax a property and two, notifying HMRC of that decision. Each party must make their own notification. You cannot rely on another person's option to tax unless you're in the same VAT group. For example, ABC Limited grants a long leasehold of a vacant commercial property. They have notified an option to tax. ABC charges VAT to XYZ on the long leasehold. XYZ will be finding a tenant for the property. The suppliers of rent by XYZ to its tenant will be exempt unless it also notifies HMRC of an option to tax. Prior to February 23, HMRC provided businesses with a letter which acknowledged receipt of an option to tax and detailed the date of the option to tax, the property details, and the VAT registered business name, address, and VAT registration number. From February 23, letters are no longer issued, and HMRC will no longer provide confirmation to a business when requested in writing of whether an option to tax has been notified if that notification was within the last 6 years. It is important to document both the decision making and the notification when opting to tax and retaining this as evidence within your VAT records. Examples of evidence for the decision making can be in the form of minutes of a board meeting or correspondence between the business and its tax advisors, where they've discussed the requirement to opt to tax and authorised the advisor to carry out that option to tax on their behalf. When notifying the option to tax to HMRC, we would recommend that it is done by email, and the relevant details are put into the subject heading of that email. When you submit the option to tax by email, the option to tax email will issue you with an automated response, which will confirm your email has been received. This can then be retained as your evidence that you have notified HMRC of your option to tax and that HMRC have received that notification. Where a business has made the decision to opt to tax but didn't notify the decision to HMRC, it cannot evidence to a potential purchaser or tenant that it has a valid option to tax. It can be possible to request a belated notification from HMRC where certain conditions are met. However, this can be a complex, lengthy, and costly process, And it is also not guaranteed that HMRC will accept a belated notification request, especially if they do not agree that you have provided enough evidence to support the decision-making stage of the option to tax process. To be able to request a belated notification, you would need to be able to evidence that you had made the decision and that since the date you made the decision, you've treated the property as though it has been opted. As an example, charging VAT on rental income and recovering VAT incurred on the property as input tax on the basis the property has been used to make taxable supplies. However, where the property is vacant, it is extremely difficult to get HMRC to accept a belated notification, as one of the conditions that HMRC asks to be met is that VAT has been charged on rental income. This can sometimes be overcome where clear documented evidence can be provided to HMRC showing the decision-making process by the business. We would recommend that consideration is given before a commercial property is purchased and where relevant documented to show that the option to tax position has been considered and the decision to opt has been made. When entering into property transactions, if a business can't evidence it had made the decision and treated the property as opted, it can be harder to move forward with those transactions. For example, where a business does not hold evidence, it can create issues for a seller confirming to a prospective buyer or tenant that the seller is entitled to charge VAT, a purchaser confirming to the seller that it has opted to tax a property to obtain a VAT-free transfer of a going concern, a target company on a due diligence review, or a business confirming to HMRC on a VAT inspection that certain properties have been opted to tax. As mentioned, a business can request a belated notification from HMRC, but this could delay the completion of a transaction, and this could then create additional costs for the business as part of those delays. If the belated notification is accepted by HMRC, the transaction generally can move forward with no further implications for the seller or purchaser. However, where a transaction has already taken place, there will likely be issues. For example, where a property has been transferred as a TOGC and no evidence can be provided that the buyer did in fact notify an option to tax. In this situation, this is a breach of the TOGC conditions and would mean that TOGC treatment was not available at the time the property was transferred, and the seller should raise a VAT invoice to the purchaser. This would be considered an error by HMRC, and if it has not already been picked up by HMRC, it would need to be disclosed. An error can attract penalties and interest, and for TOGC transactions, the penalties would be issued to the seller, as it is the seller's responsibility to get the VAT treatment correct. Because of this, it is usual to find a clause in a TOGC contract which allows for the seller to recover such interest and penalties from the buyer where the breach is the buyer's fault. In addition, SDLT is chargeable on the gross price paid. Therefore, further SDLT could become payable because of VAT being charged on the transaction at a later date. One of the main issues that we find where an option to tax cannot be evidenced is where VAT has been charged on a property. So going through this as an example, if a property has been purchased for 250,000 plus VAT, VAT has been recovered or has at least been claimed on the VAT return based on intended use at the time the VAT was incurred, which was to make taxable supplies. They try to reclaim the VAT, but HMRC query the repayment as no evidence of taxable supplies has been made and there's no evidence of an option to tax. HMRC can reject the recovery of that VAT as input tax, and therefore no VAT would have been recovered. Because of the value of the property, it would be considered a capital goods item. So although the VAT is unable to be recovered in year one, with a capital goods item, you would look at the life of the property over 10 years and recover the VAT based on the use over those 10 years. So in year two, XYZ would notify HMRC of an option to tax from a current date and is found a tenant and now making taxable supplies. It would therefore be entitled to reclaim 10% of the total input tax incurred on the property acquisition. So in year two, it would be able to recover £5,000. On the basis that for years 3 to 10 of the capital goods scheme intervals, it continues to make taxable supplies, it would be able to continue to recover £5,000 per year. So in this situation, although the VAT hasn't been completely lost, it will create cash flow issues where the VAT has been paid over to the seller and is only able to be reclaimed in small amounts over a period of 10 years. We recommend that consideration is given to option to tax for all property transactions to ensure that there's no risk to any business of VAT not being recoverable or becoming a cost at a later date. Now pass over to Steve and Paul for their topical CIS discussion.
Thank you. So yeah, over to us. That was a good Eric and Ernie start, wasn't it? Double act. So anyway,
have we got any more double acts we can do?
Yeah.
Go on.
So as we talked as a double act, I think it's fair to say, Steve, you and I have we've been around quite a long time looking at CIS, the construction industry scheme from HMRC. I guess we ought to confess we're both a long time ago ex-HMRC and have seen it from the other side of the fence. But I guess
I was just thinking we've got about 60 years worth of experience.
Well, there you go. There
we go. Yeah.
So, although a lot of people know that CIS basically means if you're not fully registered for gross payment, you can lose tax at 20% or even worse still 30% when being paid as a subcontractor. But as an intro to CIS, what is it and why was it brought in and what was the background to it all?
Well, I don't quite go back all the way, but I think it's always good just to scene set, and not everybody knows the history. And the history it's important to know the history because that does impact on where we are now and also HMRC's sort of view of the construction industry scheme. But we're talking about anything here that covers property, construction work, a phrase the revenue uses of works forming part of a land. So it can be wider than just the building. It can be the land surrounding the building as well. And it's any alteration, any sort of construction work that ends up being caught within CIS. And what you've got within CIS is all this history that we just mentioned. Now, I can take you all the way back to 1945, post-war. And post-war, there was obviously a lot of building work required in Britain. And an itinerant, shall we say, workforce was brought in to start to do that work. The problem being that a lot of these itinerant workers, once the jobs were complete, went back to their own country. And just leading up to about 1971, HMRC realised that perhaps it was losing some money. So it brought in the construction industry scheme there. It was all sort of very much paper-based, paper forms, 714 certificates as they were known, that some of you may actually remember. And basically, if you had the right certificates, it meant you could be paid gross. These became very valuable. There was a lot of money exchange for these in certain pubs and certain locations around the country. They got bought and sold and were quite a commodity and everything at the time. But if you didn't, and the reason being, as Paul's touched on, if you don't have even back then the right certificates, you ended up with suffering a 20% deduction, which was on account of any future tax and class 4 national insurance that you were due to be paying. But despite all these measures, it was a broken system. It never really worked. There was a lot of fraud, a lot of abuse of the system. The revenue let it carry on. Then sort of 1999-ish, the problems were still going. HMRC tried to change the system, tried to tighten it up. We had the introduction of sort of CIS cards, other sort of more protected documents and everything, which just to make it a little bit tighter to try and cut down on the fraud. But it's always continued. But again, 2007, the revenue decided it still wasn't working as they wanted it to do. There was still problems, there was still fraud out there. And it got sort of all overhauled, updated to really be the system and everything that we know now. It's an online system. The contractor has to register. The subcontractors have to register. When a payment goes from contractor to subcontractor, they have to go in and check what the status of their CIS is for the subcontractor. And again, it comes out, they've got a gross payment certificate, you have to deduct 20%, or you've got to deduct 30%. So it's been a changing system. It's changed so much since I was involved in, and I don't go back to 71, neither does Paul, but we go back quite a long way. I was heavily involved with the CIS in the HMRC. I was involved with doing a lot of the training, especially around the 99 and the 2007 changes and that. So I've always been there, and it doesn't surprise me because it's a complicated system, but it still does catch out to those maybe who are unwary. We have issues around property investors often don't feel that they're actually caught under CIS and that they have in strictness a need to register. We've also got this issue around deemed contractors. You have mainstream contractors, those who are their main trade is construction operations, but you also have those who are deemed to be contractors because of the amount of work they do. It used to be £1 million on average across a 3-year period. It's now got altered to being £3 million across a 12-month period. And if you do a lot of construction work, you might not necessarily be in something you think is construction, but you get caught because of the amount of work you undertake, which are construction operations. And it's also construction operations which create a problem, isn't it, Paul? Because we get lots of questions about what is actually included within CIS inside of it and what is outside of it.
Yeah, absolutely, Steve. I mean, the key to it is if you're within the construction industry scheme, the CIS as a payer, someone in your business has to decide how you treat the payments you make. So, is the work being done within CIS or is it outside of CIS? How much tax you should deduct? Have you got all the information from the subcontractor that you're paying to enable you? And it is your onus to contact HMRC, check the status of who you're paying. The revenue will then tell you gross 20 or 30. And it's your job to do. You have to do it. Other areas where things go wrong are if you have just one overarching contract and some work might be in and some work might be out. But if there's only one contract, one mixed contract, every payment has to be processed through the CIS scheme. And I think the biggest worry or thing I come across is the person making those decisions in the business. Are they confident and capable? Are they fully up to speed with changes in rules? Have they been trained, or have they just inherited the job from someone who's left? And we often offer updates and health checks and things like that. But I often say, like, who gets the blame when it goes wrong? I mean, a very good example of this is on an invoice. If you do have to deduct tax, you get the gross invoice. You can deduct the cost of the materials as the person preparing the invoice, and then just be taxed on the labour element. But it's the obligation of the payer to only deduct the cost of those materials to the person providing the services. Now, common mistakes are scaffolders will claim for the cost of the scaffold, but they already own it. It's not cost them in raising that invoice. There might be some paint left over from another job. That is not material cost that can go through CIS. They may put a markup on the materials on the invoice. And in an odd way, the person making the payment, the contractor, has to actually make a decision here on what they're going to tax, not just accept the invoice. And a tax inspection will look to the payer, the contractor, who could easily end up with back taxes, interest and penalties. And then on the flip side, as a subcontractor, somebody working within CIS and you're getting paid, if you are lucky enough to have got your gross payment status and tax doesn't have to be deducted, you really do have to keep your own tax affairs up to date, or you risk removal of that and the chance to reapply doesn't happen again for another 12 months. So that means you suffer 20% tax for at least a year, with the cash flow implications if you've still got to pay your own workers. And one area I've seen a lot of is this means both the business and its directors, and it covers keeping payments up to date for corporation tax, income tax, VAT, PAYE, even the director's own self-assessment tax returns. And everybody's got to be running a tight ship, because on a review, and there's supposed to be an annual review by the revenue, your gross payment status could be taken away. I mean, that's how it's been working in practice over years and over a number of years. But there's been quite a few changes recently that some of them might have passed people by who are operating in the scheme. Do you want to run through a few of those, Steve?
Yeah, no, I can do. I mean, a lot of them have been subtle changes which have come in since 21 onwards. They've been tweaking. The government, HMRC, has been making these minor little tweaks. I say minor tweaks. They might be minor in the scheme of things, but they can add to all the administrative burden that contractors, subcontractors, and everything already have to face. But you've covered some of them. We've touched on already. Subcontractors claiming the cost of materials was one of the change, that it has to be the subcontractor who is doing the work who's actually suffering the cost of the actual materials and paying for them themselves. So that was one of the changes in 2021. Michelle's already covered the domestic reverse charge. VAT and CIS has always been a little bit of a partnership, but it became a marriage in many ways of once a domestic reverse charge came in, for many of the reasons that Michelle's already explained. So that was one of the big fundamental changes, and it often brings a lot of questions our way. Again, often looking at is this operation I undertake in construction inside or outside of the scheme, because it can then have a knock-on effect for the domestic reverse charge. There's also been a big emphasis, this goes back to Mike really in some ways, he was talking about supply chains and understanding supply chains. Certainly supply chains from a workforce point of view and labour supply chains, there's been a tightening up on what the HMRC expects a contractor to look at when sort of engaging any subcontractors through any kind of supply chain, just to make sure they're trying to combat fraud, and they're trying to reduce as much fraud as that they think, and this is because of this historical link I talked about at the beginning, because they view CIS as being historically a lot of fraud goes on. Some of those views are right, some are less so. We also introduced when you register as a contractor, they tagged on that you had to include your corporation tax UTR on the EPS, the employer payment summary screen, to be able to actually make contractor claims. And they also increased, you touched on the gross payment status again, they increased the cost of penalties if you actually, for want of a better phrase, maybe tell an untruth when you're actually applying for your gross payment status, and there's penalties which can come your way if the revenue finds out. In more recent times, in fact, last month, April 24, a couple of other new changes came in. Gross payment status, Paul's already mentioned that it can be at risk and the issues that brings. One of the other checks HMRC will now make from April 24 is the VAT is up to date? Have you submitted your returns on time? Have you paid your VAT? There are some tolerances for late paying of VAT, and it's not trying to catch someone out who's done something wrong deliberately in VAT. It's just trying to make sure things are paid and returned at the same time. And they've also brought in and changed one of the other areas which has caused confusion over time, and this is landlord to tenant payments. I was going to mention it earlier, but landlord to tenants can sometimes, landlords to tenants can sometimes make payments which cover alterations to buildings, and it's been so complicated over the years. HMRC has tried to remove what they call the reverse premium to take it outside of CIS. So again, we occasionally get questions on that reverse premium, and the rules are now a little bit more, well, relaxed in some ways. You've got to make sure you meet certain criteria.
Thanks, Steve.
Paul, yeah, no, sorry, Paul.
I was going to say, one of the things CIS is almost linked automatically to payroll, and PAYE is another form of PAYE, and we're seeing those reappear. They disappeared during COVID, and the revenue weren't going out and visiting people and doing payroll and PAYE visits, but they're starting to reappear again. I haven't seen any for a couple of years, and we've had 3 or 4 on clients recently. Is a major area in any industry, not just the construction industry. And I think one of the important things to remember is, and going back to who's making the decisions and who's signing off, every month when you file your return of who you made the payments to, whoever is signing off is ticking a box to say that every entity or individual that you've paid should not be on your payroll, is not an employee. So if you're paying the same subcontractor a similar amount of money 12 months in a row, you're saying that you've carried out all the checks and all the tests and they genuinely are self-employed, and you're confirming positively that you've carried out a risk review and that they are self-employed. Now, you know, it's not as simple as, well, he's got his own customers, or he tells me he's self-employed, or he's issued me invoices. There are a number of tests, and the onus is on you as the payer. And there are some big implications of getting it wrong. I mean, 20,000 a year is not a huge salary, but if you're paying someone 20,000 a year as a subcontractor for, say, 4 years, and the taxman comes along and successfully challenges that they should have on payroll, that can cost you easily a £40,000 PAYE bill, plus interest, plus potentially another 40,000 in penalties. And this is just by getting this simple thing wrong.
Just on that point, Paul. I mean, it's Mike Hall here again. I have seen marked increase in HMRC activity in respect of enforcement, and you know, obviously COVID, there was a lot of forbearance around. Generally, there was actually restrictions on the ability to take action against companies. The revenue were offering quite significant sort of time to pay arrangements. You know, up to 3 years. I even heard of 3.5 years at one point. I think the wheel has definitely turned now. And when I looked at the statistics for the insolvencies, generally, obviously, not surprising, they're on the rise. But in particular, one particular type of insolvency, so compulsory liquidations, where creditors are now seemingly taking action against companies, and that is being driven really by HMRC, which is relatively recent, because for a long time they remained sort of, let's say, more supportive of businesses in the fallout of COVID, and I think now they are echoing what you said. I mean, it's about returns. They very much, they have suffered sometimes, and they've accommodated companies that maybe have been late on returns, but now they are just making assessments, and they are actually issuing statutory demands with a view to then, as the next step, being a compulsory winding up petition to be filed, which has significant implications to a business if that was even to be filed, because it basically means that they're demonstrating the company is potentially insolvent, and from that point, the directors of that business have a duty to not erode assets of that company, and eventually, if the petition isn't dealt with, will be advertised, which will then ultimately result in the bank account being frozen, and the ability of a company to sort of trade be completely restricted. So,
thanks, Mike.
I was just going to add, I mean, I had a chance conversation with somebody who's still in HMRC and actually sits on a fraud investigation team in the labour provider unit and everything, and they have a very strong focus at the moment on CIS, on labour providers into CIS from both a CIS point of view and a VAT point of view, and the revenue is putting more and more money into compliance activities. So it's certainly on the increase. CIS is viewed as by HMRC, as I mentioned earlier, and it always has been, as one of the highest risk areas within what HMRC actually does day to day, rightly or wrongly. They've never changed their view on that. So they do have a very heavy focus on this, and they'll carry on. And if we get a government change next year, Rachel Reeves has already said she's going to invest money, if assuming it changes to Labour, she's going to invest heavily in HMRC to step that up even more, and all of this be part of closing the tax gap. Sorry, Paul, I was just going to...
That's okay. No, I think just for us to finish off, I mean, this all seems like very doom and gloom, but on a positive, there's areas where we can help and support and just give you some reassurance if needed. And would you want to expand on that?
Yeah, no, I mean, definitely. I mean, the first thing is, if you've got a question, pick up the phone, drop us an email, Paul or I, and we can take this forward, and we can help you, we can support you with, those questions around, am I inside, am I outside? Don't just make a a guess at it, because it might come back to bite you. We can help you sometimes whether you're a contractor or a subcontractor. Sometimes there are arguments start to come in over between contractors and subcontractors about what is meant to happen and all those sort of sides of it. We can help. We can do a review of your CIS and your systems, your processes, to make sure that you're robust, and we can help you on that. Do take a look at our website. We've got a lot of information on the website that Paul's produced and I've produced over the years, and we try and keep that up to date. And we do get a lot of visits to CIS. I'm not blowing our own trumpet here, but we do seem to be the go-to firm for anything to do with construction industry, and it's because a lot of accountants out there do not like touching it with a barge pole, and we get a lot of referrals coming in just because, as we started by saying, Paul, you and I have both got a lot of experience, and we've got a lot of experience within the teams as well. Yeah. Okay, I think that's probably back to Heather.
I was going to move to some of the questions that have come in from the audience. So thank you very much, firstly, to our speakers. And I will go through the questions we've had. So I think the first one is for you, Michael, in relation to a question as to whether some larger companies who may be in difficulty struggling to refund or refinance historic trading debt with lenders at this time, or whether it's just the higher interest rates that's affecting them. So are you seeing this with many larger companies at the moment?
Yeah, definitely. I mean, obviously, finance costs have risen significantly, which impacts on the profit margins. I think also where with larger companies, they've obviously got significant payroll costs, and I think wages expectations have increased. There's more competition amongst employers, so we've seen that wage demands have increased, and obviously sometimes they're then issues with bigger projects. There's more propensity for issues in respect to the practical sort of completion of works, where you've got multiple subcontractors. You are seeing more potential for delays, which can then contractually result in penalties, financial penalties, LADs, and sometimes due to workmanship, sometimes due to just issues getting materials, and supply chains can result in significant sort of penalty costs, which all impact on the bottom line. And I think it's a very difficult industry, construction generally, in terms of sort of pricing. And I would urge people, and I'm sure the people on the webinar are astute, but to make sure that pricing is realistic from the off, and you don't rely upon sort of variations and sort of uplifts down the line, because I've seen in many of the insolvencies I've worked on, issues with pricing has been at core of of some of the problems that they've had, because the expected variations didn't materialize, or because of just a generally lower margin and at the outset, which has been difficult to rectify later on if the customer is particularly astute and is well represented by QSs, etc. Then that can also impact, because their job is to really try and find holes in the paperwork and the process. And so just make sure your paperwork is correct as much as you can, and that you follow up on timely orders are sort of accepted and approved by customers, so that there is little wriggle room in the future. Because again, it's not that people aren't doing the work, it's that sometimes they are unable to put their hands on the authorizations, and which can then result in that work being not being paid for sometimes.
Yeah, and working capital just generally is becoming a lot more expensive. So any delays will be harder felt on the bottom line. So that's really helpful. Thank you, Michael. We've got another question here on VAT, if I may, for Michelle. And the question is surrounding if a subcontractor invoices a contractor with incorrect VAT. For example, it's invoiced with the DRC when it should have been 20%. Is the onus on the contractor to challenge it and ask for corrections?
Yes, I think I would say that it would be. I mean, in the guidance, it's for the customer to tell the supplier whether they are an end user or whether the supplier or whether they're not, and therefore the supply is subject to DRC. So I would say that if you've received an invoice and it's incorrect, it would be for you to push back to your supplier and ask that they correct it.
So I think, as the person here has correctly said, it is adding a lot to the workload, and it's, you know, it is important work to get this right. So if you have any questions, then do feel free to reach out. And I think a further question on VAT in relation to a storage unit which is being let for storage use. The unit isn't opted to tax. VAT is chargeable on the rent as its use is for storage, and they're asking whether VAT would be recoverable on the repair costs of the unit as you have a vatable supply.
Yes, that would be the general rule on the basis that it is seen as a genuine supply of storage, which is taxable without an option to tax. Then costs that have incurred VAT, you would be able to recover on the basis you are making taxable supplies.
Perfect. That's really helpful. Thank you. And thank you to all of our speakers for today. That's been really helpful. And I think it shows how complicated the construction industry is. And at Francis Clark, we do have experts in many areas, and we do all work closely together as a team. Often there is more than one implication. Earlier it was mentioned that CIS and VAT now have a marriage, whether they like it or not. So they are closely drawn together. And again, with property transactions, properties being bought and sold, VAT and capital allowance team again work closely together, so you can often not look at one tax in isolation. So do reach out if you'd like support. So thank you to everyone for attending today. I hope you found this webinar useful. I think my key takeaways are, if businesses are struggling, then reach out sooner rather than later. Don't put your head in the sand. And that's also the case if your customer or suppliers are struggling. Dealing with things early is key. And again, the interaction between VAT, CIS, and how truly complicated some of these things now are, and to look out for those risks and also opportunities for your business. And do feel free to reach out if you need any assistance. If you're joining us for our second webinar, this will be focused on property owners. So we'll be covering topics like capital allowances updates. We'll also be looking at the proposed abolition to the furnished holiday let tax rules and what this means for holiday let owners. We'll also have a look at those structuring buy-to-let portfolios and how you may wish to own your buy-to-let properties. And also Michelle will be back to have a conversation in relation to some VAT issues for those that own properties as property owners. So again, another day full of activities. So hopefully see some of you again tomorrow. But thank you for your time and enjoy the rest of your day.